Hello everyone and welcome to this short training session about Brexit. In this video we cover the legislation changes relating to Brexit that may affect your business. So before we look at what's changing, let's start with a brief overview of Brexit. I'm sure you're all very familiar with the word Brexit, but just to give you a bit of a recap, it's an abbreviation of the words British and exit, and the official definition from the Oxford English Dictionary is the withdrawal of the United Kingdom from the European Union. Just to cover a little bit of the timeline on this, because this process started approximately 4.5 years ago now, on the 23rd of June 2016, when the UK public voted to leave the EU. The following March, 29th of March 2017, the government triggered Article 50, which is an EU treaty that sets out how EU states can leave the EU with Parliament approval, thus starting the 2-year countdown to 29th of March 2019, which was originally intended to be Brexit Day, when the UK would leave. But there have been various delays and postponements, and at the start of this year, 31st of January 2020, we finally officially left the EU and entered the transition period. That transition period has nearly ended and will officially end on the 1st of January 2021. So as we've just said, on the 1st of January the transition period will end, which means, amongst other things, the UK will leave the EU VAT regime, which means that the UK will need to treat sales and purchases to and from the EU as rest of the world exports and imports, and can no longer treat them as intra-community supplies and acquisitions. Similarly, other EU countries, including the Republic of Ireland, will also need to treat sales and purchases to and from the UK as rest of the world exports and imports. This will mean these goods will now have to go through a complex export-import process. It will also impact how UK businesses apply VAT to these transactions and account for them on their VAT return. However, these changes are complicated by the Northern Ireland Protocol, which keeps Northern Ireland tied to the EU in respect of goods. So what do we mean by the Northern Ireland Protocol? Well, the aim of it is to avoid a physical border between Ireland and Northern Ireland. The implications are expected to be the same regardless of whether the EU and UK reach a free trade agreement or not. And under the protocol, EU VAT rules will apply to Northern Ireland in relation to goods, but will not apply in relation to services. This has resulted in much uncertainty around what trade between Great Britain and Northern Ireland will look like, although HMRC's view is that this is now largely defined. In fact, HMRC has recently published additional guidance around Northern Ireland and VAT. The guidance confirmed that you're trading under the protocol if your business is VAT registered, and either your goods are located in Northern Ireland at the time of sale, you receive goods in Northern Ireland from VAT-registered EU businesses for business purposes, or you sell or move goods from Northern Ireland to an EU member state. You'll be automatically identified as falling within the scope of the protocol if your VAT-registered address has a BT postcode, or VAT-registered certificate shows a type of business that's not solely involved in the provision of services. To check if you're trading under the Northern Ireland Protocol and what to do, there is excellent guidance on the gov.uk website via the link you can see on screen. Let's move on then and take a look at what's changing, starting with the UK, including Northern Ireland. First, let's look at importing goods, business to business, or B2B. So before the transition, in terms of importing goods from the EU, they were referred to as acquisitions, and no customs processes are required. UK VAT would be applied via reverse charge. The VAT is calculated by the customer based on the invoice value, and the tax point is dictated by the normal tax point rules, which are usually the invoice date. For importing goods from the rest of the world, they're referred to as imports. The UK import VAT would be applied at customs, and VAT is calculated by customs based on the import value. The tax point is the date that goods were cleared for free circulation at customs. Now, post-transition, all imports to Great Britain will be treated how the rest of the world imports are treated today. Northern Ireland will continue to treat EU acquisitions and rest of the world imports as they do today. However, to ease this process, import VAT could be accounted for via postponed accounting. The UK government have confirmed that postponed accounting will be available for all imports, so that's EU and non-EU, from the 1st of January. Like the reverse charge mechanism used for EU trade, whereby import VAT is not physically paid up front and then reclaimed on the subsequent VAT return, but is instead accounted for as input and output VAT on the same return. The net effect is the same, but the importer benefits from not having the initial cash outflow, which is then recovered. It's optional on an import declaration basis, but it's mandatory if you defer the submission of customs declarations. A new online monthly statement will be available, which will show the import VAT postponed for the previous month on a transactional basis, and when you should include it in your VAT return, i.e. the correct tax point. Postponed accounting will be available for all UK businesses, including Northern Ireland. Northern Irish businesses will not need postponed accounting for goods coming from the rest of the EU because there's no import VAT, but they could still use it for rest of the world imports and potentially for imports from Great Britain. To summarise postponed accounting, let's look at how it works without postponed accounting versus how it works with. So without postponed accounting, what that means is that UK VAT registered businesses importing goods to the UK will be required to pay import VAT on or soon after the time that the goods arrive at the UK border. But with postponed accounting, those UK VAT registered businesses importing goods to the UK will be able to account for import VAT on their VAT return, rather than paying import VAT on or soon after the time that the goods arrive at the UK border. So there isn't that initial cash flow outlay. Something else that's new is the £135 import scheme for the import of goods. So at the end of the transition period, the UK government will introduce a new model for the VAT treatment of goods arriving into Great Britain from outside of the UK. This will ensure that goods from EU and non-EU countries are treated in the same way, and that UK businesses are not disadvantaged by competition from VAT-free imports. For import of goods from outside the UK, in consignments not exceeding £135 in value, the point at which VAT is collected moves from the point of import to the point of sale. This means that UK supply VAT, rather than import VAT, will be due on these consignments. For business to customer, the UK VAT will be charged by the foreign seller. For business to business, the UK VAT will be reverse charged to the UK customer. This scheme is mandatory and is for Great Britain only, so it's not relevant for Northern Ireland. Low Value Consignment Relief, or LVCR, which relieves import VAT on consignments of goods valued at £15 or less, will be abolished due to this new arrangement. More details of which you can find with the link you can see at the bottom of the screen. We just mentioned that scheme isn't relevant for Northern Ireland, so if you want further guidance on how VAT will apply for goods imported into Northern Ireland from outside the UK or EU, you can find that using the link on screen. Moving on to services then, and before the transition, the general rule is that business-to-business sales of services are generally subject to VAT in the country of the customer, with some exceptions. Therefore, VAT is usually applied in the country of the customer via reverse charge. Business-to-customer sales of services are generally subject to VAT in the country of the seller, with some exceptions. Digital services covered by the MOS scheme, for example. Therefore, generally, the seller should apply UK VAT, otherwise apply VAT of the destination country, which you may be able to report through MOS. Post-transition, these basic rules are the same globally and will not change as a result of Brexit. However, for the UK, so both Great Britain and Northern Ireland, businesses will have to start using the non-union MOS. UK businesses will no longer be able to apply the €10,000 MOS threshold, meaning more businesses may register for MOS and have to apply VAT of the destination country. Just to emphasise that these are general rules, but it does illustrate that, with the exception of registering for the non-union MOS scheme for services, you'll likely carry on doing what you are today. If you're in any way unsure, please speak to your accountant. Next we have exporting goods. So pre-transition, in terms of exporting goods to the EU, starting with business to business, intra-community business to business sales are known as supplies. Providing the supplier has verified the customer's VAT number, the invoice is zero rated, and VAT is applied in the destination country through the reverse charge. For business to customer, intra-community business to customer sales are known as distance sales. Below the distance selling threshold, VAT of the seller's country is applied. Above the threshold, the seller has to apply VAT of the destination country. For exporting goods to the rest of the world, All rest of the world exports are zero rated for UK VAT, regardless of whether they're business to business or business to customer, and tax may be applied in the destination country via import procedures. Post-transition, all exports from Great Britain will be treated how the rest of the world exports are treated today. This may result in additional EU VAT registrations, and Northern Ireland will continue to treat EU supplies and rest of the world exports as they do today. Something else that's changing is the VAT return. Now, it was originally anticipated that there would be no changes to the wording of the VAT return boxes as a result of postponed accounting or leaving the EU VAT regime. But in November 2020, this decision was reconsidered, and boxes 2, 8 and 9 will be changed. These changes don't take effect until the 8th of April 2021, and the function of the boxes will remain the same. So the new wording is as follows. For box 2, it will be called VAT due on this period on intra-community acquisitions of goods made in Northern Ireland from EU member states. Box 8 will say total value of intra-community dispatches of goods and related costs, excluding VAT, from Northern Ireland to EU member states. And finally, box 9 will say total value of intra-community acquisitions of goods and related costs, excluding VAT, made in Northern Ireland from EU member states. Other things to consider are EC sales list, Intrastat, and mini one-stop shop or MOS. So for EC sales list, any goods sold under the Northern Ireland Protocol should continue to be reported on an EC sales list. But other than this, EC sales list will no longer be required. For Intrastat, businesses moving goods under the Northern Ireland Protocol will still be required to prepare Intrastat arrival and departure declarations for these goods. Goods not covered by the Northern Ireland Protocol will still need to be reported on Intrastat arrivals declarations, but that's only on a short-term basis, so for 2021, in order to gain the required statistics. Then we have Mini One-Stop Shop or MOS. So any business using the VAT MOS scheme will need to transfer from the Union scheme, which is for businesses in the EU or have a branch in the EU, to the non-Union MOS scheme for businesses not established in the EU. If you want more information on MOS, you can find it via this link you can see on screen. Then we have Northern Ireland VAT registration. Under the Northern Ireland Protocol, EU VAT rules will continue to apply in Northern Ireland after the end of the transition period in respect of goods. In terms of change, if you're trading and make transactions under the protocol, you'll need to use an XI prefix in front of your VAT number when communicating with an EU customer or supplier. So your invoices will show an XI number ahead of your VAT number. For example, XI 123456789 instead of GB. It's worth pointing out, however, that as far as we're aware, there's no requirement to apply for or be issued with an XI VAT registration, i.e. it's sufficient to just use XI in front of your existing number. EORI numbers next then. So if you import or export goods into or out of the EU, you need an EORI number. Previously, this would only have been a UK requirement for imports and exports outside of the EU, but from January 2021, there'll be a requirement if you move goods between Great Britain, so that's England, Scotland and Wales, and the EU. You may also need one if you move goods to or from Northern Ireland. If you move goods between Northern Ireland and non-EU countries, then you'll need an EORI number that starts with XI. If you need to get an EORI number, you can do so from gov.uk/EORI. Let's move on to commodity codes, which are standardised numbers allocated to goods in order to classify them for the purpose of calculating the correct tariffs and taxes upon importation into a country. They're required for import and export declarations, but aren't required for EU intra-community trade, although they are used for Intrastat reporting. Previously, UK businesses therefore only had to use commodity codes when trading outside of the EU, or for completing Intrastat reporting, but will now be required to use them when trading with the EU. Commodity codes aren't a requirement for a VAT invoice, but they should be included on any commercial invoice. If you need to look up commodity codes, duty and VAT rates, then go to gov.uk/trade-tariff. That's the UK covered then, but what is changing in the Republic of Ireland? Let's take a look. Well, first of all, sales of goods to Great Britain will now be treated as rest of the world exports. Any sales of goods to Great Britain with a consignment value under £135 will now be covered by the new UK import scheme. So business to business, UK supply VAT is accounted for by the customer via reverse charge. On business to customer, UK supply VAT is charged by the seller, who will need to register for UK VAT. Purchases of goods from Great Britain will now be treated as rest of the world imports. And sales and purchases of goods to or from Northern Ireland will continue to be treated as intra-community dispatches and acquisitions. But you'll need to use the new XI country code to reflect these transactions on supplementary reporting and use the XI VAT registration for your Northern Ireland customers and suppliers. Great Britain should be excluded from Intrastat reporting and EC sales list reporting, and Northern Ireland should be excluded from a services perspective. The UK, so Great Britain and Northern Ireland, should be excluded from MOS reporting. Any UK VAT due on business to customer sales of services will now require the seller to register for UK VAT. And you'll need to use EORI numbers and commodity codes when trading with Great Britain. We talked about postponed accounting in relation to the UK a little bit earlier, but in terms of the Republic of Ireland, under previous no-deal Brexit preparations, the Republic of Ireland confirmed that they would also implement postponed accounting. This was to reduce friction and cash flow impact on Irish businesses of import VAT as a result of trade from Great Britain to the Republic of Ireland. The underlying legislation required for postponed accounting in Ireland has now been laid before Parliament and will make its way through the various stages. Revenue have issued some high-level guidance, which hopefully provides some reassurance that it is coming and will be in place for the 1st of January, along with the required changes to the VAT3 and RTD forms. You can find that guidance using the link you can see on screen. Finally, from a legislation changes perspective, it's worth considering a Brexit impact assessment. Some tangible things to think about and do to be ready for January. Let's take a look at an example. So here are 5 questions for you to answer to ensure you've got everything in place for the end of the transition period. The first of which is based around import, export and logistics. Does your business import or export goods to or from the EU? And on the back of that we have EORI. Do you need to register for an EORI number? Then got Northern Ireland Protocol. Does your business trade under the protocol? Taxes and money. So is your business VAT registered, or do you operate under the VAT MOS scheme? And finally, software. Is your account software up to date? All that remains for me to say is thank you very much for watching this video. Stay safe, and I'm sure I'll speak to you again very soon.